Fed Governor Chris Waller said that if inflation continues to fall, then the Fed in the next several months could be cutting interest rates. I wonder if you could comment on whether you agree with Fed Governor Waller on that. That
the answer is it depends on the reason. If you're cutting rates because you're going back to normal, that's one thing. If you're cutting them because the economy is really weak, so you can imagine you have to know what the reason is to know whether it would be appropriate to do those two things at the same time.
What is going on with Jerome Powell and the Federal Reserve? At the end of their December meeting in mid-December, the Fed surprisingly telegraphed that we might get 6 Fed rate hike cuts in 2024. Now it's a scant 8 weeks later, and the markets are thinking we might get 3, half the amount promised, or implied rather, in December. So what's going on? Well, in this gold market update for February 16th, 2024, we're going to drill down on what's happening with the U.S. economy, interest rates, the dollar, and of course we'll get into precious metals charts and talk about all the factors that have changed over the last 6 to 8 weeks to make the Fed, take a step back on what's happening with their projections for 2024. So I'm Dana Samuelson, president of American Gold Exchange in Austin, Texas, and we will get into our update. Here's Jerome Powell. Surprisingly, in December, the Fed said, we're about ready to pivot next year. And now, just 8 weeks later, well, maybe not so fast. So what's happening to change that forecast? In this gold market update, we're going to look at inflation, which is getting a little sticky, and the market's knee-jerk reaction to it. The U.S. economy remains resilient. GDP and jobs remain pretty good, which is causing the Fed's promised pivot to fade for fewer rate hike cuts expected now in 2024. Meanwhile, the U.S. consumer, which is 70% of our economy, has got new record high credit card debt. Is the U.S. consumer getting tapped out? That's a very important consideration. Also, we'll go through the latest charts for the U.S. dollar, Treasury yields, gold and silver, and we have a silver special that we call Bullion with Muscle. Let's get into our charts. Let's start with inflation, because inflation has been driving the bus for the last couple of years with its moonshot from 0 all the way to about 9% and now back down. So this is a chart of the consumer price index going back to 2000 with headline CPI inflation in light blue and core CPI inflation in dark blue. As you can see, the current rate for headline CPI is 3.1%, down from 3.4% in December. Core CPI, however, remains steady at 3.9%. So inflation's getting a bit stickier. It's holding up for the headline CPI right at about 3%, a full percentage point above the Fed's 2% target. And that's where the rub lies. Now, this last mile may be a lot harder than the Fed imagined. So what's going on with inflation by component? Let's take a look. Food and beverages and housing combined, especially housing, make 60% of the consumer price index, just a hair less, with housing coming in at about 44.4%. You can see since October, we have seen food and beverages drop about 70 basis points from 3.32% to 2.55%, while housing has dropped about 65 basis points from 5.25% down to 4.6%. Now, these numbers continue to diminish, which is good. I do think that the market knee-jerk reaction we got to a little bit hotter than expected inflation in the components year on year, not month on month, year on year this week was a bit of an overreaction. Meanwhile, we've got headline CPI holding, coming down from about 3.35% specifically to 3.09% over the last month, and core CPI edging just a bit lower, only about 7/10 of a point, 0.07 of a point rather. So core CPI is holding steady. Meanwhile, just today, we got wholesale prices, the producer price index, and they were sharper than expected. So U.S. producer prices rose 0.3% in January, the most in 5 months. Year on year, wholesale inflation increased 0.9%, up from a forecast of 0.6%. The core PPI, less food and energy, rose by a stiffer 0.6% to keep the 12-month rate unchanged at 2.6%. So wholesale inflation is holding up. Well, most of this is services. And what are services? Well, they're wages. And wages are up about 4.5% year on year, higher than the inflation rate right now. So the consumer has a bit more spending power relative to inflation than they've had for quite a while. And we're seeing that in the economy. We'll talk a bit more about that in just a minute. But that's really what's helping to create inflation remain and keep it remaining sticky. Now, Jim Rickards talked about inflation at the New Orleans Investment Conference in November. And he said supply side inflation tends to resolve itself while demand side inflation tends to reinforce itself. So we had COVID supply shock inflation, which has now been resolved with the supply lines fully loaded again. But now demand inflation, specifically wages and housing, are holding up. And that tends to be stickier inflation. So the Fed may have a little bit harder road than they thought going this last mile, getting inflation down that last 1.5% to 1% to their target. They may have to raise their target. We don't know. But the hotter than expected consumer inflation data, the elevated wholesale prints suggest higher prices may be with us for longer than expected, potentially delaying the Fed's plans to pivot towards lower interest rates. And that's really where the rub is. The economy has been better than we expected, and the consumer's spending, and that's helping to keep inflation stickier than they expected it might be at this point in time. So this is a chart of US GDP. This goes back to the first quarter of 2021. You can see relative, 2021 was a pretty good year, despite the fact that inflation was surging and we had COVID issues. 2022, the first half of 2022 was negative, but it wasn't a recession. How they figured that out, I don't know. The next 4 quarters have seen diminishing GDP from 2.7 to 2.1%, followed by a shocker of 4.9% in Q3 of 23, and then another good print in Q4 of 23 at 3.3%. So GDP for the last 2 quarters is better than it's been for the last 8. And that's what's going on and helping to reinforce inflation. So GDP is good. The economy is doing pretty well here in the US. But we are the only economy in the world right now that's doing well. China has been weak, as you know. Japan has basically just gone into recession. Europe is weak because of what's going on with the Ukraine war over there. So the US economy is really the only economy that's fundamentally performing right now. Let's take another look at the economic activity via jobs. This is a monthly job creation bar chart going back to January of 2021. And as you can see, since about the summer of 21, all the way into November of 23, on average, the jobs have been trending lower. We've seen a couple spikes along the way, but in the last 2 months, we've had 2 really good job prints of about 345,000 jobs created in December, and then a little over 353,000 jobs created in January, better than expected. So employers here in the US continue to hire, with the unemployment rate at about 3.7%. And the weekly job claims coming in pretty steady. The US economy continues to look pretty good. And that is all reinforcing inflation a bit, which is causing the Fed to take a step back, saying, hey, we've got to reassess here because the US economy is not weakening like we thought it would due to the interest rate hikes that we made aggressively in 2022 and into 2023. And the consumer remains more resilient than we thought. So we may have to walk back our rate hike projections from December from 6. The market's now expecting 3 rate hikes in 2024. And here are some of the quotes from Fed governors talking about inflation and the prospects for 2024. Fed Governor Barkin said recent progress on inflation might be a head fake, and that's what we're seeing in the numbers over the last 2 months. Inflation's proving to be a little bit stickier than people anticipated it might be. Fed Governor Kashikari says the inflation isn't all the way to where the Fed's 2.6% goal, so rate cuts can wait. And Fed Governor Collins said inflation's getting closer to 2%, but the Fed needs more proof. So they're going to take a bit of a wait and see approach here instead of getting into the meat of it like we thought they might just 8 weeks ago. But here's a little bit of a rub. The US consumer may be getting tapped out. Credit card debt has increased by another 50 billion to a new record high of $1.3 trillion, the highest it's ever been. I mean, this was about 950 billion in October of last year, and it's an average of $6,360 per credit card. So that's quite a lot of credit that has been given on credit cards, and interest rates on credit cards are now over 20%. So people are paying a lot of money to buy forward. And we saw pretty aggressive spending for the Christmas holiday season, which contributed to this record high. And now we're seeing retail sales for January, which were just released, drop quite a bit, down 0.8%, which is to be expected following kind of a binge buying cycle, Thanksgiving to Christmas holidays. So we'll have to see how this continues to go forward. But the consumer via credit card debt is starting to look tapped out to me. Now, here's a sign that we don't like to see, which are credit card delinquencies are starting to rise. They bottomed in the summer of 2021. And then as inflation's bite really started to take spending power away, we've seen credit card debt surge, but now we're also seeing credit card delinquencies rise. Now, this is still relatively low, going from about 1.5% on the dark blue line up to about 3% as of Q3 23. We don't have the latest figures yet, but credit card delinquencies are rising. So that means some borrowers are having trouble paying their notes on a monthly basis. The good news is mortgage delinquencies are low, and they're staying low. And that makes sense because a lot of people aren't putting their houses for sale because they don't want to trade out of a lower rate mortgage into a much higher rate mortgage today. Most homeowners have loans going back to pre-Fed rate hikes and pre-interest rate hikes. So that's good news for mortgages. So let's take a look at interest rates next, because all this ripples into interest rates. This is a 2-year chart of the federal funds rate in black, the yield on the 2-year Treasury in purple, and the yield on the 10-year Treasury bill in red. And as you can see, since last October, yields on both the 2 and the 10-year Treasury have been dropping pretty sharply going into December, but now they've gone sideways. And in the last couple of weeks, they've started to really perk up. And that's in response to the economy here in the US doing better, and the fact that the Fed may have fewer rate hike cuts than they led us to believe they might have at the end of their December meeting. So interest rates are perking back up on the Treasury yields, which is hoping to keep the cost of financing higher. And that, again, should help to slow the economy down. The economy remains resilient. So time will tell as we move forward into the next month or two in 2024 where all this is really going to shake out. I think inflation will continue to ease a bit. I think we've seen a bit of an overreaction to some hotter than expected prints. And we'll talk about that a bit more in the precious metals and in the dollar. Here's a US dollar chart. As you can see, over the last year, the dollar has been pretty choppy, trading primarily between 101 on the low and 105.50 on the high. Now, gold tends to trade inversely to the dollar. That's why we've put gold tags on this dollar chart. So you can see when the dollar is strong, gold tends to be weaker in price. And when the dollar is weaker, gold tends to be higher in price. So why is that? Well, most of the gold around the world is priced in dollars, but it's bought outside of the United States. It's bought in China. It's bought in Japan. It's bought in Asia, other countries. It's bought in India. It's bought in Europe to a much higher rate than it is in the US overall. But when the dollar becomes strong, it makes gold more expensive in other currencies. And when the dollar becomes weak relative to other currencies, gold becomes less expensive. That's why when the dollar is weaker, gold tends to be higher. Now, on the dollar index chart, which had been falling pretty sharply since the double peak in October and November at about 106.7, we've seen the dollar make a big drop going into the beginning of 2024, but now it's rebounded. And that's a direct relation to the Fed reducing the projection for rate hike cuts, meaning the interest rates will stay higher, which means the US economy is performing better relative to other economies. So the dollar is stronger. And it's popped over short-term resistance where that red line is at 103.50 in just the last couple of weeks to a high of 104.85. I think the dollar is going to settle into about a 102 to a 104.5 range and be a bit choppy over the next couple of months. Because I do think the US economy is going to weaken a bit, and I do think inflation is going to wane a bit further. And that's good for gold. So let's take a look at gold right now. This is a 1-year gold chart. You can see it's been choppy, performing pretty much in inverse relationship to the dollar. We've had 2 lows last March of 2023 at 1820. And then on the back of the SVB bank failure, gold ran all the way to 2055. Gold settled into a $1,915 to $2,000 trading range for most of the rest of 2023. It weakened in October, but then Hamas attacked Israel and gold caught a bid. And today, based on the dollar, I think gold is about $100 higher than it might be. However, the war in Israel is not going well. Israel's pretty much cleaned out the Gaza Strip. They've got more work to do, they say. But the conflict has gotten outside of Israel's borders. Israel is increasingly going at it against Lebanon on their northern border. We've seen the Houthis in Yemen attack shipping in the Red Sea. The U.S. has responded by going after some of the Houthi military capabilities. Shipping has been dramatically affected. There are not many ships going through the Red Sea right now because of all this. So ships are having to go around the South Africa instead of going through the Red Sea. And that is adding insurance costs and energy costs to shipments and time. So all this is fundamentally a bit inflationary. Meanwhile, since November, gold has been basing over $2,000 an ounce pretty steadily for the first time ever, with a new high at 2093 set in late December. So gold is looking very strong right now relative to the dollar, relative to the US economy, relative to stronger interest rates, and relative to what's happening internationally. Remember, the war in Ukraine continues. Well, that's worked out to a bit of a stalemate. But international conflict is as high as it's ever been in years right now. And it's not good. And that's helping to buoy the gold price. On the latest price action, we've seen gold drop from about 2070 all the way to just over 2,000 on this chart, which is a futures chart. Now, the price we're seeing on this chart is the April contract. And this past week, with the hotter than expected, with a little bit stronger than expected CPI print, and now the producer price index print, the spot price of gold did get a little bit under 2,000 for the January delivery, which is now, or I'm sorry, February. We're in February now. At about 1991, it bottomed 2 days ago on a bit of a knee-jerk reaction to the hotter than expected inflation rate. With the higher yields, with the yields on the treasuries bumping up. But gold has rebounded since and is up a little bit higher than this chart shows at the close of business on Friday, February 16th. This is from yesterday, yesterday's market close. So gold is looking pretty good. And I do think over the next year, we'll see gold advance into the $2,100 to $2,300 range based on a weaker economy, a weaker dollar, lower interest rates, and perhaps more continued conflict in the world, because what we have going on in the Ukraine and in Israel, I mean, they're not going to end. These conflicts are not going to end easily or quickly. I do not think. Let's take a look at silver. Silver has been underperforming gold. It's trading at less than its 2 previous highs of about $50 an ounce, where gold is setting new all-time highs in the last couple of months and trading near all-time highs. So silver has been choppy. Over the last couple of months, it's been under the resistance line there at the right-hand side of the chart at $23.50 an ounce. When the Fed announced their alleged pivot in December, it popped a couple of bucks to about 26.64. That's the short-term high. It has been edging lower, and it did get pushed down to almost $22 an ounce on this knee-jerk drop due to the inflation print the other day, but now it's rebounding. So silver's catching a bid. And as we go to market close on Friday today, it's actually about 23.50 an ounce, back up to the top of the resistance level, right at it. So this chart shows yesterday's close again. So silver is trading at a much lower price relative to gold than we think it should. With gold at around $2,000 an ounce, I think silver should be closer to $35 an ounce than $25 an ounce. And I think when silver plays catch up, it will do so with a vengeance. And we've seen it do that a couple times in the bigger picture over the last 15, 16 years. Let's take a look at the gold to silver ratio chart. This is a chart that measures the number of ounces of silver it takes to equal an ounce of gold. In modern times, that ratio has been between 48 to 1 and 82 to 1 pretty steadily until we got into the COVID era when things rotated a bit higher because gold is leading now and silver is lagging. But twice we've seen this ratio change dramatically. The first, going into the great financial crisis of 2008, the ratio was about 82 to 1, with gold at $7.75 and silver at under $10. And then when silver finally played catch up to gold doubling in price, it went up 5 times in price from under 10 to almost $49 an ounce, pushing the ratio down to 32 to 1. So when you can buy silver at a high gold to silver ratio and you're patient, you can be rewarded handsomely in moves like that. And we saw a similar one due to COVID when the ratio was about 95 to 1 before that big spike, which was an anomaly at 125 to 1. That's completely COVID related. It was very short term and didn't last. But a ratio of 90 to 1 or higher is really high. And when silver played catch up, going from about $15 an ounce to almost $30 an ounce, the ratio dropped from about 95 to 1 down to about 65 to 1. And that's the kind of catch up we see silver can play when gold runs and silver lags and then finally does run hot. And today the ratio is about 85 3/4 to 1, with gold at 2015 and silver at 23.50. It was a little bit higher a couple weeks ago when gold was in the 2060, 2070 range, and silver was still around 23.50 an ounce. So the ratio's down a little bit, but it's still very high at 85 3/4 to 1. So silver's a great buy right now. Speaking of silver, we have a silver special, and that is on junk 90% silver dimes and quarters made by the U.S. Mint 1964 and earlier. These are the old dimes and quarters that used to be 90% silver by weight that went out of the currency in 1965. We don't have to pay anyone to make these. We trade what survives in the marketplace today, the attrition of use as currency and the couple of great melting pot melts we've had over the years when the silver price got red hot. A lot of 90% got melted. So it's a supply and demand market in addition to being a metal market, which is why when there's a lot of demand, like we saw during COVID, premiums on junk silver can jump quite substantially. And today we've got not only a low silver price at $23.50 an ounce, we've got a high gold to silver ratio at 85 3/4 to 1. We've got a low premium on junk 90% silver. At $1.99 over spot, junk is the lowest it's been since before the COVID demand waves took premiums much higher across the board. So junk silver is a great buy right now, and it's actually cheaper per ounce than sovereign minted 1 ounce coins that are minted in unlimited supply every year. So you can get a great trading sized coin at a low premium and a low price today. So I think junk silver is a great buy in the current market if you want to add silver, and especially silver that might be good in a crisis to your portfolio. So that's our update. This is how you contact us. We are a national physical precious metals mail order dealership out of Austin, Texas. We're in our 25th year. We have a perfect business record. Thank you for your time today. If you like what we're doing, please hit your like button and subscribe to our YouTube channel. We'll be doing more videos in the future. We can't thank you enough for all the support you've given us for 25 years. Our clients are our best asset, and without you, we wouldn't have a business, and we never forget it. So thank you so much for your time, and have a great day.